Back to Beer and Money. My name is Ryan Burklo.
And I'm Alex Collins.
Alex is back from his 2 week vacation, camping trip with his daughter, all that kind of fun stuff. So welcome back, Alex.
Thank you. It definitely didn't feel like 2 weeks, but amazing trip. Got good chance to just go out, reconnect with nature, get a chance to hang out with my daughter a bunch. It was an amazing trip.
Awesome, man. Awesome. So today's episode, we're going to be talking about everyone's favorite topic. Don't get too giddy and excited. We're going to be talking about life insurance. And I say that sarcastically because let's just face it. I mean, if I'm being completely blunt, I don't really talking about life insurance either. It's like a horrible subject to even consider. But the fact of the matter is I don't know about you, Alex. Like if something did happen to me or you, in whatever whichever case, how do you want your family taken care of?
Yeah, for sure. It's one of those things where it breaks our brains a little bit to try and contemplate some of this stuff, but at the same time, like way better to have thought about it ahead of time, prepared, and it's hope for the best, plan for the worst.
Exactly. So most like the top three questions we get is how much life insurance should I get? That's probably number one. Number two is the cost, and that might be 1B. Like 1A might be how much should I get, and 1B is what's the cost. And number three is what's the type of policy we should get. And so today's episode, we're going to be talking strictly on the amount of life insurance to consider getting. But before we dive into that, Mr. Collins, what are you drinking today?
I mean, for me, the question that I usually get is, how much should I get? The second question is, how much should I get? And the third question is, how much should I get? Like, yes, the other things factor in, but like 9 times out of 10, it all comes back to like that first question. But to answer your other question, Ryan, today I am drinking Batch 15. It's an IPA, shocker, by Aslan Brewing out of Bellingham.
Have you been up there before?
I have.
They've got their brewery up there. I absolutely love. They got a couple up there. We go to the one where our kids can go, and their food up there is also really good.
Mm-hmm.
So we go every time we go up to Bellingham. We had three breweries up. We had Colshan, we hit Boundary Bay, and we hit Aslan every time. So definitely a nice one to have, nice one to try out. I was at the store and the color caught me. I'm a very feminine man, and this one's called Cloud Mentality, and it's called Hop Burst. It's a hazy IPA. It's by 10 Barrel. It's a 7% alcohol and 55 IBUs. I've never had it, so I'm going to try it out. Have you tried this before, Alex?
I have not had that one. 10 Barrel is good stuff. I enjoy 10 Barrel's beers.
It's pretty solid. It's not very hazy, though.
It's got some haze to it.
Yeah, I don't know. I normally like it hazier, but it's a lot of hazy IPAs, they can be more of like a winter type of drink because of how full they can make you. This one is it's very refreshing. I'm full of good stuff today. Refreshing, colorful. So, and no, that was my first sip of alcohol, everybody. So, all right, well, let's dive into today's conversation. So,
wait. So what do you think of it was Cloudburst?
Cloud Mentality.
Cloud Mentality. How is Cloud Mentality?
I said it was good. I said it's very refreshing.
How many bottle caps do you give it, buddy? Is this a
bottle cap? We haven't done a bottle cap rating in a while. I'm going to give this one 8 out of 10.
Yeah, so batch 15. It clocks in at 6.7, and it's mid 60s in the IBUs. This is an incredibly solid IPA. I've tried this a few times. I'd forgotten how good this is. This is a 9. I'm probably going to put this into regular rotation of like IPAs that I drink.
No, it's a solid one for sure. Yeah, absolutely. All right, you ready to transition to everyone's favorite topic?
Yes.
Okay, cool. So life insurance. I'm going to share my screen here. And when we talk about life insurance, it's in Alex and my mind, it's actually a very simple conversation.
Yeah.
And it comes down to, look, life insurance is the replacement of your income. Right? Because your income is what is allowing you and your family to live the life that they want. Right? Like, I don't
Yeah.
know how you argue otherwise. So the question comes down to, okay, how many years of income do you want your family to have?
Yeah, I mean, like so much of this is like thinking about it from the standpoint of cash flow being your most important or most critical financial tool. And when we take a look at protection, whether it's life insurance or anything else, what we're really protecting is your cash flow, and maybe to a lesser extent, or as you get older, it's not so much about protecting your current cash flow as it's protecting the the accumulated savings or the assets that you've built up that are going to transition into being your future cash flow.
Yep. It's always cash flow. And I, make sure you pay attention to our last episode where we talked about tax distribution strategies. And we talk about what Alex just said. It's about the correlation with the stock market, or it uncorrelated with the stock market, and specifically protecting your assets and having a cash flow in retirement to the most efficient way possible. Today's episode is more about protecting your income while you're in your working years. And so the balance sheet you're looking at here, this is a pretty typical balance sheet that Alex and I see, right? This couple
Yep.
makes 300 grand a year. They save a good amount of money, almost 20% of their income. They've got a good amount of retirement already sitting there. They've got a little bit of Roth. That's pretty standard for us to see, is mostly traditional, not a ton of Roth. A little bit of savings. Maybe they could use some more. That's, again, it goes back to each individual situation. And then you've got their debt. So again, I'm not going to go through all of the numbers here. When we do look at and we do see a typical client that we see, this is what we see. And death benefits we tend to see is 750. Maybe we get up to a million.
Million.
Randomly, or every once in a while we might get to two, but we don't see anything other really differently other than that, because most of the time these benefits are tied to their employer.
Yeah, and it's something where oftentimes what we'll see is we'll see that they've maxed out what they can do through their employer, and maybe they've gone out and gotten $500,000 or $1 million worth of coverage outside of it, and haven't really thought about it or looked at it in quite a while.
Yeah. So what I want to do is, what we normally do when we're working with clients is we sit down with them and we start to, okay, look, our job is to show you what happens if that horrible event occurs. What happens to your family?
Yeah.
Our client's job is to understand if they're okay with it. Okay. And so what I just showed you was that couple had about $640,000 of assets. And we're going to look at, let's just say this couple is 35 years of age. We're just going to keep it ultra simple for today's conversation. We're going to go ultra stereotype. They're 35. They're going to work for 30 years. They're going to retire at age 65. Okay. Now, rate of return. They got $640,000 sitting in the stock market in their 401ks and the Roth. How much rate of return does this couple expect? Alex, what are the typical answers you get when you ask a question like that to your clients?
I mean, so much of it depends on how much conversation we've had ahead of time. If I haven't had much of any conversation, I usually get answers somewhere between 6 and 10%. If we talk about it as like, okay, well, what about net after tax? If we've talked about it as like, okay, do you want to take as much risk as the market? Now, normally we wind up anywhere from 3 to 6.
So we're going to go the 6 to 10 that Alex just mentioned. I'm going to use 8% because we're going to meet in the middle. To Alex's point, we do get that range. We're going to use 8% for this calculator. Okay. And so just to show what this calculator is
Hold on
doing,
a second, right? For a net after tax rate of return of 8.
we're going to say 8%, Alex.
Okay,
The S&P returns 10%.
sure. Assuming 20% withheld for taxes, sure. We can go at 8.
Let's go 8. So $640,000 of assets growing at 8% over a 30-year period of time grows to $6.4 million
With nothing added to it.
with nothing added to it. Now let's start adding what they're currently doing. We've got Mr. Incomes coming in the door, and he makes $150,000 a year. And if we were to ask, actually, I know many of our listeners are in the car listening to this. If on your income, what do you expect your income to do over the next 30 years? Do you expect it to go up? Do you expect it to go down? Do you expect it to stay level? I've never had anyone tell me it'd go down or stay level. Everyone always tells me it's going to go up, especially over a 30-year period of time.
Yep. Most of the time I get, well, it's going to go up, or at least I hope it's going to go up.
Right. And so the next question I have is, okay, why, what percent? 9 times out of 10, they always say some inflationary type number, 3 or 4%, right? So I'm going to choose 4% for this calculator. So we're adding his income. Now we're going to add the other person's income because they're both working. Again, same 150, same inflationary type bumps in terms of income. Okay. So $300,000 of income. Now, this couple saves, technically they save 58,000. I'm going to make this ultra simple for math. Yes, I could do the $2,000 difference, but I'm also taking into consideration just simplicity here. If they were saving 20% of their income, that's $60,000. 20% of 300,000, 60 grand. So what that means is how much of that is not being saved?
240, Ryan.
Mr. Analytic nailed it.
You're asking all the hard math questions.
I really am. So again, I want to, like, this part normally stops every time I do this calculation, normally stops the person. They go, wait a minute, what? And what we just did is if we have $300,000 of income coming in the door and we subtract out the $60,000 that they're actually saving, that means they're not saving $240,000.
And sometimes people get into arguments about semantics of like, oh, well, my lifestyle isn't 240. It's taxes or it's my mortgage or whatever else. And it's like, no, that's all dollars that are going out the door that you're not saving. So it all needs to get, and sometimes instead of calling it lifestyle, I'll just call it life.
Sure. Again, semantics of the word, but the fact is this couple, and even those of you listening, whatever you're not saving is what's not being used, meaning it's not getting saved. Right. So 240 grand, I'm gonna use the same 4% increase, right? Because most people, as their income goes up, so does their lifestyle. So now we're going to calculate here and we're going to see what they're quote unquote on pace to have at retirement. So as we look at this, $17.5 million.
That's a really good, healthy number.
Really good, healthy number. And what just occurred to me, for those of you listening, this couple is normally in their mid 40s. So this is further on in life that has a $640,000 assets. I realized it just caught me. Like, why is that such a higher number? That's not typically what we're not seeing the 30 or 35-year-old with this, but let's just do the exercise anyways. If they had $640,000 of assets, growth for 30 years at 8%, $17.5 million, that's what their linear trajectory is.
Exponential trajectory, but sure.
So now let's take into consideration life insurance, which is the whole purpose of today's conversation. So they had $750,000 of life insurance, right?
$750,000 a piece.
So what we're going to do is we are going to have one of them pass away. And one of them passes away next year. Okay, so $750,000 is going to come into their balance sheet. And it's going to come into their balance sheet next year, which means one of them, their income no longer is coming in the door. So that means Mr. Income, I'm going to kill off the Mr. Income. They work for 1 year and they pass away. Now, we're not going to get into the weeds of how they passed away. They could have passed away from cancer, spending a bunch of like assets to try to save them. Like, who knows? In this instance, let's just say they got hit by the number 5 bus. Okay. $150,000 is no longer coming in the door. What does this balance sheet turn into? They were on pace for 17.5. What does this look like? So as we hit calculate here, now we're going to see what the actual balance sheet looks like. So this couple's got kids, younger kids. The balance sheet, you can see the $750,000 enter in year 2. And you can see that they are red really by year 25, just about. Like they barely make it into year 26. Or they don't make it into year 26. They barely make it to year 25.
And so instead of ending up at retirement with $17.5 million, Ryan, hover over the last red bar there. they end up actually in debt. What is that, 1.3?
Yep.
That's almost a $19 million difference. That's how big of an impact not having one of the spouses earning $150,000 a year, increasing at 4% in just inflationary numbers, not even giving them promotions or job changes or anything else over a 30-year time period.
Now, keep in mind, this is year 30. This is when they're 65. So every once in a while, we'll have someone say, well, their lifestyle will change. My question is, do you want their lifestyle to have to change? I mean, that's really the number one question I'll have. But let's just say they can magically cut their lifestyle, and this person can go from a lifestyle of 240. I'm going to make up a number, 200. I really don't know what this is going to look like. We didn't rehearse this ahead of the podcast here. So
Sure.
they just cut their lifestyle by 40 grand a year. Let's see what occurs. So the good news is they're now at 5.7.
So it went positive, but at the same time, we're still almost $12 million in the hole.
So I want you, like, for those of you who are thinking, well, $5.7 million, that's a lot of money. You're not wrong. It is a lot of money. But put yourself in this couple's shoes for just a second. We just showed them that they're on pace for $17.5 million. What kind of dreams, what kind of goals, what do you think they were wanting to do that just got squashed because of this? Because 17.5 down to 5.7 is drastic.
Yeah.
And that's cutting their lifestyle by 40 grand, snap of the finger.
When so like I just did some super quick math. Like that 5.7 sounds like a ton, but that's the equivalent in today's dollars
Yep.
of having less than $70,000 a year in retirement. So this couple that was making $300,000 with a lifestyle of $240,000 a year, yeah, if we cut the lifestyle back, and half the time what we see is that lifestyle stays the same or maybe even gets more expensive because taxes all get more expensive because there's only one spouse. A lot of times if we're raising kids, we now have extra expenses to like help make sure that the kids are taken care of and get to go to the same things that they were getting to go to. And like if you have one person in a room versus two people in the room, you don't get to cut the electricity bill in half. Like,
Yep.
So oftentimes we wind up seeing expenses stay right about the same, but at retirement, this person would have to take over a 50% reduction in an already reduced lifestyle.
And I'll throw another caveat into this because I really just skipped over it. Alex started questioning it from the get-go, and I'm going to now bring it back into play. He was questioning the 8%. When your spouse passes away, are you going to stay aggressive in the market?
You can't because you need the money a lot sooner. And
You're distributing this money to yourself. Like that's what this couple is doing, or this person that's left is doing. So let's just cut it by 2%. So it goes from 8% to 6%, which by the way, that's still 6% net is still 8% gross. Like that's still rather aggressive.
Mm-hmm.
And we calculate now, and now you can see it's down to $2 million.
And that's going to wind up generating roughly $80,000 a year before you start adjusting for inflation, and $80,000 adjusted back for inflation at 4%. Like now you're talking about somebody living on $25,000 a year in today's dollars.
So too often we see this over reliance upon market rates of return. And functionally, this client or this person just pseudo retired. If they're starting to distribute some of those assets to them so they can continue the lifestyle that they're accustomed to or some semblance of the lifestyle, because keep in mind, they bring in 150. Their lifestyle after I cut it by 40 grand is still 50 grand higher than the income coming the door, which means they're distributing to themselves 50 grand in year one with a 4% inflation. So it's drastic.
Yeah.
And what Alex keeps alluding to is this 4% rule of thumb. So there's a rule of thumb out there called the 4% withdrawal rate, where you can distribute 4% of your nest egg with a low risk of outliving your money. That's what that is. And so oftentimes when Alex and I are talking about life insurance, we go over this to show them how they currently look. And then it really sits with most people. They're sitting there going, okay, how much should I get? And it comes down to, okay, well, you can look at how many years of income do you want to replace, and or look at it from the standpoint of, okay, the 4% withdrawal rate, because you just kind of set up a mini retirement, pseudo retirement, because we don't know what's going to occur. And so for every million of assets that you've got, you can distribute 40 grand.
So in order to create the $150,000 of income, we would need 3.75 million in assets to account for it.
At the minimum.
Yeah.
Because again, there's way too many variables here. So that's today's episode, is really kind of discussing what you should be looking at when you're looking at how much life insurance should I get, is like from an income perspective, how many years of the income do you want to replace? Which takes us to the question of the day, Alex.
The question today is exactly what you were just saying, phrased a little bit differently. How many years of income do you currently have protected? And maybe more importantly, was that an intentional thought that like we set it up with the idea of like, oh, hey, $1 million of coverage is 5 years worth of income?
Yep. So head over to beermoney.net, and at the top of that page is a contact us, as well as there's going to be this specific episode out there where you can actually look at, we'll have the YouTube channel. We'll always put the video there in that specific episode. And today's episode is probably a good time to look at the visual side so you can see the numbers that we were just talking about and seeing how this comes into play, right? All of these numbers are variable. We don't know what the income number truly is going to be. We don't know what the income raising, what that ratio is going to look like. We don't know what the rate of return is going to be. We don't know if you're going to be actually saving 60 grand a year, because, at some point, maybe you'll send your kids to college and maybe you won't be saving any money that year. There's a lot of variables here. And when it comes to protecting your income, in our mind, you want to eliminate as many of those variables as possible. And that's really getting the most amount of protection that makes the most sense for you and your family.
Absolutely. I mean, it's critical to have these conversations and to have them ahead of time, because when we're having them after the fact, it is too late to have most of these discussions. We can try and add value and try and minimize damage from a loss like this, and try and help people figure out like, okay, how do we create an income stream from whatever lump sum of money that we've received. But we're able to help families way more proactively than reactively. If you have questions on like, if you want to challenge Ryan and I on any of the things that we talked about, or want more details on like, okay, well, why this or why that, or have questions, head on over to beerandmoney.net and drop us a line.
Look, we started this podcast to hopefully have you think differently about your money and look at everything on a truly holistic level. Right? Because this conversation on life insurance tends to be more of a needs analysis. Like, how much do you think you need to, send your kids to college? How much do you think you need or want to leave in terms of income for your wife or husband? All of these, what do you think you need? And the fact of the matter is actually a very simplistic conversation. How many years of income do you want to leave your family? As always, we hope this episode is valuable for you. And Mr. Collins.
Cheers.
This podcast is for informational purposes only and is not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that individual situations can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. Guest speakers and their firms are not affiliated with or endorsed by Park Avenue Securities, Guardian, or Quantified Financial Partners, and opinions stated are their own. Guardian, its subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Consult your tax, legal, or accounting professional regarding your individual situation. All investments and investment strategies contain risk and may lose value. This material is intended for general public use. By providing this content, Park Avenue Securities LLC is not undertaking to provide investment advice or a recommendation for any specific individual or situation, or to otherwise act in a fiduciary capacity. Please contact a financial representative for guidance and information that is specific to your individual situation. Ryan and Alex are registered representatives and financial advisors of Park Avenue Securities LLC, OSJ 200 Market Street, Suite 1850, Portland, Oregon 97201. Phone number 503-221-1226. Securities products and advisory services offered through Park Avenue Securities, member FINRA, SIPC. Financial representatives of the Guardian Life Insurance Company of America, Guardian, New York, New York. Park Avenue Securities is a wholly owned subsidiary of Guardian. Quantified Financial Partners is not an affiliate or subsidiary of Park Avenue Securities or Guardian. Ryan Burklo, CA Insurance License Number 0K24924. Alexander Collins, CA Insurance License Number 0H24806.
Pinpoint number 2024-178691, expiration July 2026.